Thanks everyone for joining us. I'm personally super excited for this panel. We have an all-star panel, as I'm sure you can tell. As a brief introduction, my name is Leeor Shimron. I'm the VP of Digital Asset Strategy at Fundstrat Global Advisors, and I'm also a Forbes contributor where I write about crypto and blockchain. Fundstrat is an independent research firm providing equities and crypto research to over 200 institutional investors and 700 retail investors. Now, I am super excited to dig into our topic today, yield farming and liquidity mining, which is the hottest topic within DeFi, and DeFi itself being the hottest space within crypto. Now we have a lot to get through, so let's jump right in. Why don't we start with everyone just briefly introducing themselves. Let's start with Nate, and then Loong, and then Kain.
Yeah, hey, I'm Nate from Bancor Protocol.
Hey, I'm Loong, CTO of Ren Protocol.
And Kain, founder of Synthetix.
Now, I would love to briefly just define what yield farming, liquidity mining is. So why don't we, each of you take a second just to define it in your own words.
Hey, everyone, can you hear me?
Yeah, man.
Oh,
yeah, we got it.
Hi, guys. Hey, sorry, I was...
All right, here we go, the last piece of the puzzle.
Yeah, sorry, I was missing the magic link there. Yeah, everyone, I'm DeFi Dad. I'm a DeFi super user. I use all of these folks' applications, and I also host the Ethereal podcast and work on the Ethereal Summit. So if you like DeFi tutorials, go to defidad.com. And yeah, Leeor, finally, good.
Yeah,
Thanks for having me. Do you want me
so why don't we just briefly define yield farming for everyone in our audience today?
Yeah, so the way I define yield farming is it's actually pretty simple. I think about it as you are providing liquidity. You're normally being, paid for providing that liquidity. And providing liquidity normally happens with either assets that are idle or assets that maybe you regularly use to provide liquidity. And then the last piece of the puzzle is you're earning multiple forms of yield. So that normally comes in the form of interest, lending interest, market making fees, like the swap fees you would earn on Bancor. And then the last one I think of is pooled rewards, much like what Synthetix actually and Ren have offered for different yield farming programs. Basically, they have a pool that is rewarding you beyond the usual mechanisms that are defined by DeFi protocols. All right, who's going to follow that, huh? Good luck following that, guys.
Actually, follow-up question for you, DeFi Dad. So where did the yield farming meme originate? Can you provide some historical context?
So I'm going to need some help on this. What I understood it to originate from was, I thought it was one of the centralized exchanges, liquidity mining, but we're going to just forget that, revisionist history, and we're just going to say that Synthetix actually created it about a year ago. The meme wasn't created. Kain, you guys, what you called it, liquidity or LP rewards.
Yeah.
And was the first program was the synthetic ether pool, right?
That's right. That's right.
So they had this brilliant idea that in order for Synthetix to be successful as an exchange, they needed an entry and an exit valve. And in order to trade synths, you need synthetic ether or one of the synths. And anyways, they basically started offering weekly rewards for being an LP in that Uniswap pool. And that ended about a year later. And then I'd say the real meme that we should discuss is the farmer meme. Really got popular after the comp mining started with Compound. So that's been more fun to watch, just because I think it was only a few months ago, somebody created a meme of a farmer that said, it's this very famous one. It's not much, but it's honest work. And I don't know, just the whole community latched onto it. And now it's thought of as, you're doing this work of farming the yield. So that's where I saw it coming from.
Yeah, Kain, a question for you. So I think one way that I think about yield farming is kind of like an early stage tech company that is trying to bootstrap its growth really by offering incentives to use the product. Think of SoFi or PayPal offering a cashback bonus incentive for signups or referrals. What do you think will happen once yield farming incentives dry up? Will this place implode, or is there enough actual utility to continue user adoption and growth?
Yeah, I mean, I think that's kind of, specific to each protocol, right? Is this creating an actual marketplace, right? If you were to pay everyone to use Uber, to go back and use like a traditional startup example, right? If everyone were paid to use Uber, you get a lot of people using Uber, and then if there was no actual demand for the Uber service and you remove that payment, then people will stop using it. I think that's fairly obvious. The big question in kind of DeFi at the moment is there intrinsic demand, and are we juicing up that demand? Are we starting to bootstrap it and create more incentives on one side of the marketplace? And that, I think in some cases is pretty obvious. I mean, Uniswap, there is demand to use Uniswap. So if you add additional incentives like Synthetix did, you get much more demand for providing liquidity. You start the flywheel going. For some of the protocols, it's less clear if there is actually intrinsic demand. But I think when we look at things like is there demand for trading assets on an AMM? Absolutely. And so if you create a protocol that bootstraps that through protocol incentives, that can actually really significantly speed up the process of bootstrapping that network.
Great. Yeah, makes a ton of sense. Loong, a question for you. Are these incentives just a new form of asset inflation that will ultimately tax holders over time and put downward pressure on price as the supply grows?
I think that they're kind of two different questions. I mean, yes, obviously inflation taxes token holders, but I think in a lot of cases that's actually a good thing. So I think one of the things that's really common in yield farming is that essentially what's happening is you typically have a protocol that generates some yield naturally, let's say compound, and then you add an additional incentive that if you borrow and lend, you're also going to farm comp. And the idea is that comp is a governance token that's going to help influence how this protocol evolves over time. It's actually really important that people who are just sitting on their comp and not actually care about interacting with the protocol get inflated out. I think that's a really important utility of these kind of incentives. Because at the end of the day, you're not actually changing the value being captured by comp. All you're doing is you're increasing the supply and redistributing it to the people who are actually using it. If you suddenly 10x the supply and you hand it to the people that are actually using the protocol, then anyone who's just sitting idly by and doesn't really care and isn't engaged, they're going to have a much smaller influence. I think there is, though, on the other hand, a risk that these incentives attract people who actually really don't care about governance, and they're just there for the farming. So they're going to come and they're going to use the protocol, get as much comp as they can, and then just dump it because they don't really care about governance. They care about making money. Having said that, I think that doesn't matter. Comp is not there for it's not intrinsically, or I don't think it's primarily meant to be a tradable asset. It's primarily there for governance. So if you are just there to farm comp to make money, great, do sell it, get rid of it, give it to people who actually care about it.
Great. Yeah, and I think you brought up an interesting point about governance and network ownership. That's really kind of the main goal here, right? Maybe Nate, maybe you can dive into this a little bit more. Kind of how does the governance and network ownership component fit into yield farming?
Yeah, I mean, network ownership and distributing that is, I would say, one of the major goals. I'd say another major goal is just a plain good old-fashioned growth hack to offer a subsidy like you guys have addressed in order to really bootstrap that early sort of that early participation, that active participation in the network. And I think in some ways we sort of needed the plumbing before, right? We needed the this AMM liquidity pool structure because it gives us a chance to really validate who is playing that active role, and the active participation. The way that yield farming has taken off so far, it's that if someone is contributing liquidity, you can sort of verify that immediately by just looking at the liquidity pool and seeing, which wallet addresses, what percentage of ownership, and then you can really easily distribute the rewards through this kind of container. So it's definitely a mixture of both, distribution of network ownership, and also really providing that sort of subsidy to sort of bootstrap that early active participation in the network. The key is going to be sort of balancing between those two forces. And when one, or at least the subsidy, gets ahead of the sort of governance, and your users aren't actually sticking around and holding on to the governance token and just dumping it after they take their yield, I think that's where we start to run into some issues.
So Nate, would you say it's fair to say these mechanisms are kind of similar to how early blockchain protocols bootstrapped their growth in the beginning, like Bitcoin, where you had really high inflation early on, and there's the hope, even to this day, that transaction fees will overtake the inflation. Is that kind of similar in what's going on?
Yeah,
there?
sure. I think from our perspective, we sort of approach it as we're the sort of infrastructure. We provide an infrastructure, the automated market maker, the liquidity pool to facilitate the sort of distribution of a governance token or of some sort of token. And at the same time, we too are trying to bootstrap active participation in our own network, right? And we had to kind of come at it, which is, do we want to implement the rewards sort of before establishing that we have a very clear transaction fees coming through the pools and a lot of activities within the pools. And I think, we really needed, from our perspective, to solve a lot of the underlying issues of AMMs before dropping, these massive rewards and subsidies on our own network. Because, again, if your users aren't sticking around for the actual demand of the service and aren't actually generating those raw transaction fees, then they're just going to kind of leave the service after they receive this incentive.
Got it. Great. Kain, question for you. Although DeFi really has been around for about 2 years now, we've seen DeFi tokens, they've experienced a massive boom in valuations just this year, and more specifically in the last few months. Why is this happening now? Has there been any specific catalyst that you can point to?
I don't think, comp, we've been talking a little bit about comp. I think that was one of the first protocols that had really built out network effects before issuing a token. And so I think, that kind of exercise of issuing this governance token created a lot more awareness that, tokens could work. There was a period for, quite a while, for, 2 years or so, where, projects that had issued tokens were, had this kind of black mark against their name, right? The idea of like having done an ICO in the past or something like that was seen as pretty problematic. And I think the comp token issuance and the way that they went about it, and having this blank slate governance token kind of reset those expectations a little bit. And I think that people realize actually maybe tokens can act as this coordination mechanism to get people within an ecosystem to do the thing that you wanted. And so I think that was a really positive change in the overall mindset. And then people started looking around. I mean, it had been happening before. The early DeFi advocates had been kind of noticing this for a while with things like Lend and Ren and SNX, et cetera. But I think that the broader crypto ecosystem kind of saw that comp initial issuance and said, maybe there's something here. And that was what started the big movement towards this DeFi awareness.
Right. Yeah. So I think it is fair to say that comp was kind of the first iteration, and now you're seeing this Cambrian explosion of other projects that are trying to follow a similar model based off of the result and that really increase in liquidity and usage within that platform. I think to make things a little bit more concrete for our listeners, I'd love for Kain and Nate, if you can both speak to a specific example of how users are liquidity mining or yield farming on your respective platforms.
Yeah, I mean, I can start. So, one of the things that we're working on at the moment, and this is in partnership with the Ren team, is incentivizing synthetic and tokenized Bitcoin liquidity on Ethereum. So one of the things that I'm very passionate about is bringing the BTC maxis across over to the Ethereum ecosystem to kind of give them the experience of what DeFi is like, and allow them to kind of leverage these assets that they've got sitting, on centralized exchanges or hardware wallets or whatever, and bring them into a place where there's actual activity going on. And so we started this, I think maybe like 8 weeks ago. So a couple of months ago, we started this pool within Curve where you could take Ren BTC, Wrap BTC, synthetic Bitcoin from Synthetix, put it into a pool, and it would allow people to kind of move, this AMM pool would allow people to move between these different forms of synthetic Bitcoin and, accrue fees and, both trading fees as well as protocol incentives. So, if you're watching this and you've got a bunch of Bitcoin, it's probably one of the best ways to kind of get started is to, go to the, Ren protocol, wrap your Bitcoin, using that bridge and put it into Ethereum, and then, provide liquidity for this particular pool. The incentives are really powerful, and it's like a pretty safe step, I think, to get into the yield farming process, without going too crazy into degen immediately.
Mm-hmm.
Nate, can you
yeah, sure. So Bancor is a network of AMM liquidity pools similar to, you could say, Uniswap and Balancer and Curve. Users deposit their liquidity and get a share of the trading fees that are generated and passed through the pool, and also any rewards, whether they come from BNT staking rewards dropped on the pool or whether they come from projects that incentivize their pool, and also even lending interest that you can use the sort of stake liquidity to simultaneously lend out. For us, it was amazing to see, as I said, this kind of primitive become the sort of primary container through which yield farming is happening. From our perspective, though, the legacy AMMs, the existing AMMs today, pose some pretty serious issues and trade-offs for yield farmers. The fact that they have to come to the pool and split their holdings. Let's say if I want to come to a link pool on Uniswap or on Bancor, I have to split my link into the separate reserve asset, whether that's ETH or BNT or another reserve asset. So having that kind of forced token exposure can also create these sort of complex risks like impermanent loss. We also saw a lot of sort of rigidness in the curve inside of AMMs. So while we think this is an incredible sort of primitive to distribute these staking rewards, we do think there's some kind of primary issues with this sort of primitive and how it exists today, and that's really a big part of what kind of our next protocol version, Bancor V2, introduces, with single token exposure and permanent loss mitigation and more capital efficiency in the bonding curve.
Yeah, and congratulations on the recent launch, by the way. That's really awesome.
Thank you. Appreciate that. Super exciting.
Loong, I'd like to turn it to you. Let's talk about tokenized Bitcoin. So Bitcoin has been kind of slowly invading DeFi, now I think totaling over $200 million. What role will Bitcoin play in DeFi? And does the growth of Bitcoin on Ethereum fundamentally threaten or support either one of the two blockchains?
I think it really depends on how it ends up shaping up. I think there is a huge risk that working directly with wrapped Bitcoin can be very dangerous. And I mean that generically, I don't mean WBTC. So any kind of tokenized Bitcoin that you put on Ethereum, if you leave it as tokenized Bitcoin, just as if it was a normal ERC20, then what we're going to see is that as more Bitcoin moves to Ethereum, you're going to end up with this kind of issue where all of the activity on Bitcoin ends up actually happening on Ethereum, which is super risky for the Bitcoin network, which means it's super risky for the Bitcoin holders that are sitting on Ethereum. But that can also be super risky for Ethereum. If Bitcoin moves there and becomes a dominant form of collateral, and then the underlying Bitcoin network fails because all of the Bitcoin activity has moved away from its own chain, this presents serious issues for any protocol that's using it as collateral. So I think one of the really important things, and something that we try to focus on very hard with the Ren protocol, is to make sure that the user is actually always interacting with Bitcoin. So you may make a deposit into Bancor to provide liquidity as part of an AMM, but you're making that as a Bitcoin transaction. And when you withdraw that liquidity, you're getting it back as real Bitcoin. Under the hood, of course, what's happening is it's getting tokenized and it's getting placed there as an ERC20. and then the ERC20 is getting withdrawn and getting burned back into real Bitcoin. But the Bitcoin is only sitting on Ethereum as long as it's actually being used and it's actually got some utility. It doesn't end up sitting in someone's wallet as an ERC20, just, wasting space, I guess. And I think at the end of the day, Bitcoin is always going to be safest on the Bitcoin chain and should only be on Ethereum when it's actually being put to good use. Because no matter, even if you had the perfect interoperability protocol with absolutely zero risk, which obviously cannot exist, at the end of the day, you're still compounding your Bitcoin risk and your Ethereum risk instead of just having Bitcoin risk. So I think it's really important that as we move forward and we see more tokenized Bitcoin, we really keep this in mind. Making sure that actual Bitcoin transactions are happening is necessary for the Bitcoin network to stay safe. It's necessary for protocols that are using Bitcoin on Ethereum to stay safe as a result. And it's also turns out to be necessary for the protocol that sits in the middle that's transitioning that Bitcoin back and forth. It's also necessary for that to stay well incentivized.
Got it. Great. DeFi Dad, turning to you. So Ethereum gas costs have reached all-time highs, and we're seeing transaction costs of sometimes over $10, which is pretty crazy. Do you think that limits the utility of DeFi? Will it discourage users from interacting with products, especially if high gas costs aim to the profits of small users?
I think I got all of that, Leeor. My internet was starting to go out. The question was, how are users affected by high gas prices? Like, will that affect new yield farmers and so on?
Yes.
Yeah. So there's actually like a lot of hacks to this right now, but I think the first thing anyone should be considering is we have to get better at forecasting or being knowledgeable enough about what is the yield that you're expecting to earn. And I think that those that are yield farming regularly understand that. But as newcomers, come into the DeFi space, I really think about them like making sure that they don't FOMO into an opportunity, not realizing that let's say someone has as little as $100. They might end up paying enough gas that it would be more than the profits that they would make. So I think that's the first thing that folks need to be aware of. But I mean, long term, of course, I'm looking forward to Ethereum 2 delivering and helping to solve for this. In the meantime, there's all sorts of hacks, like you can use a DEX aggregator like 1inch, and they use the Chi token, and that helps to provide for lesser fees or net lesser fees. There's also Matcha, which is a DEX aggregator as well by 0x, and Dharma's wallet just released a program where they're not offering completely free trading, but it's much better than what you would pay otherwise. So there's all of that. And then really there's like simple best practices like using the ETH gas station. So this is something I try to put in all my DeFi tutorials because I think a lot of people are still unaware of this. Even sophisticated like yield farmers, if you just check ethgasstation.info, you can quickly see if I pay this much gas, I'll get a transaction through hopefully in less than 2, 5, and 30 minutes. And so I tend to not have transactions stick, but I also tend to lower my cost of gas over time. So it's not the answer that you want to give for those that are new to our space. And we're thinking about how do we help the average person with as little money as they want to start with to start yield farming. We're not there. That is definitely a shortcoming of like where we are with Ethereum right now, but we'll get there.
Mm-hmm. Yeah, and as a follow-up to that, speaking of users, how would you characterize the users that are in DeFi and specifically yield farming today? Clearly there's quite a few barriers to entry. Typically, I would imagine that you have to be more technically savvy and understanding of crypto in order to be comfortable using these protocols. But how would you characterize that?
I think the folks that are every day having to check on all of the different yield farming or DeFi opportunities that they're invested in, those are folks that are very tech savvy. They're very finance savvy, or they've grown to be very finance savvy. However, I think one of the things that I've noticed, and this is, there's no data behind this, it's just my like personal firsthand experience over the last few months. I mean, my inbox is flooded with people who are clearly starting out with smaller positions, much in many cases less than $100. I've talked to a lot of people recently in countries that are outside of the United States, Western Europe, Australia. These have been folks who were very forward that like this is a really precious amount of their wealth, and I'm basically trying to warn them of all the risks and educate them on that. So I think we really are at the start of something bigger. Like I've never seen so many questions about how can I put, again, $100 of Ether to work, and that's why it goes back to your question about gas prices. It's a limiting factor. So you really have to think, how can someone earn the largest reward without having to succumb to outrageous gas prices?
Got it. Yeah, so unfortunately we're rubbing up against the end of our time, so I'd love to close out with one final question. What is in store for the future of DeFi and yield farming? What exciting innovations are yet to be built? I'll open the floor for anyone to take this.
So, I mean, I think, from my perspective, to carry on from that thread of, how do we get more people? How do we make it more accessible? The transition to L2 in the interim while we wait for, E 2.0 is, I think, going to be a big change for people. I mean, we did a demo a few months ago now with the Optimism team where, the cost, we did tens of thousands of transactions and the cost of those transactions, even on a test net, even if you assume that all of those transactions were pushed to L1, were cents. And so I think we can solve this problem. I think we can, move to L2 solutions, in the interim and really kind of, mitigate some of these gas issues. And so we're working really hard to kind of accelerate that process.
From my perspective, I think the future of yield farming is really one in which the staking incentives and the LP rewards are not the sole driver of APR when you're staking inside an AMM pool. We're at a stage where actually a lot of people are they've totally forgotten about fees, right? We're seeing like, which pools can I get the most, yield farming on? And they've totally forgotten kind of like that fees can actually drive really high APR. So as we sort of tweak the AMM primitive and make it where we can really lock in the fees and generate higher fees for less liquidity, I think you'll start seeing yield farming as really a supplement, these staking rewards as a supplement, and in addition to the fees, where from my perspective are really going to be the cash cow for driving high APR for these farmers.
I'd have to agree with that. I think fees are really fundamental, and I think part of what I see coming for DeFi and yield farming, of course, is interoperability. I think it solves a lot of these problems where you can introduce the capability to give supply to places where there clearly is demand. There's obviously demand to get permissionless and trustless yield on your Bitcoin. Now that we have tokenized Bitcoin in a trustless way, you have access to that, and you can actually start generating fees from these assets that were otherwise dormant previously. With support for things like Zcash as well and Bitcoin Cash. And as this asset list grows, we're going to see more and more markets open up. Instead of just trying to convince more people to use ETH, you can actually get entirely new classes of users that weren't possible before. And that's going to bring a lot of people into DeFi. Like if you ask your average person on the street, what's Bitcoin, they know exactly what you're talking about, or at least at a high level, they might know what you're talking about. If you ask them about what is ETH, what is DeFi, they probably have no clue. So I think interoperability is a really important point for bringing demand and driving up fee usage. But I also think it kind of ties into Kain's point about fees, where at least until ETH 2.0 gets here, soon you'll be able to offload a lot of your DeFi activity onto other chains and then bring those assets back when you want them back. So you might be able to take ETH and put it onto the Polkadot chain where fees might be lower at the moment. And we may end up seeing fee aggregators that will make a trade for you, but they'll bounce it through the networks that are going to be the most efficient.
Great. DeFi Dad, would you like to chime in?
This might be self-serving, but I think one of the things that just still holds us back is education. And I think that what's been built already by Kain, by Loong, and by Nate, it's more than good enough. It's revolutionary in terms of what you can do with your money. And so my argument has been for the past year that even if there was no further innovation, like we're at a place where we can continue to grow exponentially. However, I'm very grateful for the work that the three of them are doing and other teams. So I feel kind of lucky that we're in a place where we can continue to onboard and educate folks on how to use this. But my heart is in how do we help someone with 20 DAI be able to earn interest and to store that wealth reliably and to not have to worry about losing something like a seed phrase. That's exciting to me, but we're still in that, we're just too small of a community still. And there's lots of folks out there that need to learn how to use all of these money applications.
Great. I think that's a great point to wrap it up. So for the panel, thanks so much for joining us. I know this was super informative for me, and enjoy the rest of your day.
Thanks, guys. Bye.
Thank you.
Thanks, everyone.